Hello all and welcome to today's webinar. It's Thursday the 17th of August. It's just gone the stroke of midday, so we're going to get underway on today's webinar for Market Matters. My name's James Gerrish. I'm the lead portfolio manager at Market Matters. Really thrilled to have so many of you on the line today, and hopefully we can give you some ideas around what we're doing in the market, how we approach the market, given we're in the vortex of reporting season at the moment. To help me do that today, I'm going to bring in very shortly Harrison Watt and Shawn Hickman, who will guide us through the presentation. Today, we're going to have a broad brush chat around the market and stocks that are of interest to us. As I said, reporting season is really heating up at the moment. We've had a heap of companies reporting today, yesterday. The market's fallen a couple of percent in the last 2 days. So there's a lot to get across in terms of markets. So without further ado, I just want to get through a quick overview of the panel. So as I said, my name's James Gerrish. I'm the lead portfolio manager here at Market Matters. We're a digital advice service. I'm also the senior portfolio manager at Shaw Partners. Shawn Hickman, he's the lead research lead, I should say, at Market Matters. 30 years experience. Great to have Shawn on the line. And Harry Watt, who's a portfolio manager at Market Matters and also works alongside me in the portfolio management area of Shaw Partners. If the dynamic's a little bit off today, we've got two Aussies and one POM. So obviously, after last night's result, the POM is feeling better than the two Aussies. So if the dynamic is a little bit off, that is the reason why. Just before I get underway, just a quick disclaimer there. Any advice provided today is of a general nature only, and we don't consult your personal circumstances. And you should consult a financial professional before making any decisions on what we discussed today. So I'm going to bring in the team right now. So Harry and Shawn, you can jump online and I'll introduce both of these guys. So you're on the line there, guys. We're coming from three separate areas.
Yeah, good morning, James. Well, good afternoon now, James, and all our guests.
Thank you, mate. In terms of Shawn, you're still muted, so jump on the line there, mate.
Okay, can you hear me?
I can hear you now. So, and you can start your videos if you like, if you haven't already done so.
You've got to let us in, I believe.
Alrighty. There you go. You should be able to start your videos now, guys.
Perfect.
Alrighty, so I'm just going to kick off with a quick overview of the performance for our portfolios in the FY23. So we obviously had a good year in terms of portfolios. The flagship growth portfolio, which we tend to focus a fair amount on, had a pretty strong year. So it was up around 24%. The international equities portfolio did better, and then the active income and emerging companies were below that. On the screen in front of you is just a quick overview of a bit of street cred around how our flagship growth portfolio has performed over longer periods of time, and it's we've been doing particularly well in terms of our activities in the market. FY23 really was a really strong year for us. So to beat the index by nearly 9%, we're really pleased with. In terms of, I was nearly 11% to be honest, in terms of the flagship growth portfolio. So really thrilled with that, and we're going to, I guess, uncover some of the ways and thinking around the markets that we have that have led to that strong outperformance in terms of the market. We're really focused on a couple of key areas that Market Matters. So we're really focused on telling it how it is, being real around how we write about the market, being timely in our approach to the market, writing about things on a daily basis. We just touched on performance, so we've got to anchor everything to performance and measuring of our performance outcomes, and we certainly do that on the Market Matters website. And transparency in our approach. infuriates me the lack of transparency in our industry, and both Harry and Shawn share this view. We're really about the good, the bad, the ugly, being transparent in what we're doing, and being transparent in a timely way, not picking and choosing what we describe as the outcomes we're achieving, not only posting the winners when they're closed, not only posting the losses, but showing it all. And I think that's a really important differentiating factor for Market Matters. And I know that's why the bulk of subscribers really like what we do. So I just wanted to reinforce that point before we get on to the content of today's presentation. We've also, in the past 12 months, we've launched a direct investment service called Market Matters Invest. It allows investors, subscribers, and other investors out there to invest directly in our portfolios. It's an easy approach to take. It's an easy account to open, and we'll detail some of the ways you can do that later on in today's presentation. I'm going to bring the guys in now, and we're starting very top level. As I said before, we're in the vortex of reporting season. The ASX 200 chart is on your screen there. I'll start with you, Shawn, just to give a quick overarching view, sort of where we are from an index point of view before we dig into some of the themes that we've seen so far across the reporting landscape with Harry.
Thanks, James. Obviously, the first thing to say, that's already a little bit out of date after today's 1% fall, give or take. But the really overriding issue is here. The market has gone sideways now for over 2 years. And as we keep saying in the reports, hopefully not boringly, but this market is all about stock and sector rotation. Until further notice, the index is trading in a 10% range. Don't get fixated on the index. There are times to do that. This isn't one of them. This is the time to be in the right sector at the right time, the right stocks within that sector, hopefully. Do not focus on the index too much.
I think that's a great point. I think hopefully it's one of the takeaways from today's webinar is around when you show some stocks with really varying performances and how we've handled them, what we're thinking about them, and how our thought process evolves over time in individual positions that we have across portfolios. Harry, what's your? We've been really focused on reporting on the desk. We write a lot about company results. We attend a lot of company meetings and updates with management. A lot of calls after results. Very high level, very succinct. What's your take on reporting so far?
Yeah, well, we're about 2 weeks into reporting at the moment. It's been sort of a mixed bag. Generally, from a top level view, it's probably been as expected in terms of FY23 numbers, more or less. Most results coming in within a few % of consensus expectations. But it's FY24 guidance that has really been lacking. So companies haven't really been able to come out with pretty solid guidance for FY24. If we have a look at specific sectors, resources have been focused on costs. That's been a big issue for them over the last few years. So trying to manage their costs there. Banks are pretty confident. We heard from NAB earlier on, and they put out a $1.5 billion buyback. So they're pretty confident in their balance sheet.
And CBA there as well, Harry.
Yeah, CBA as well. The number of banks just buying back shares. If we have a look at property, that's been a pretty mixed bag. Even yesterday within the results, Dexus might have been a bit light, but Mirvac was really good. We were pretty bearishly positioned in terms of the market heading into this result. So the market was sort of expecting a pretty poor reporting season from property, and we're mostly getting that. If we have a look at retail, there's been calls for retail to be falling off a cliff over the last 12, 18 months. It hasn't come through yet. That's been really resilient. So big tick for retailers. And industrials is just really mixed, as it always is. It really depends on which sort of specific areas within their sectors and their industries that they're playing in. So overall, but FY23 probably is a tick for most companies. FY24, it's sort of a wait and see approach at the moment, James.
And I think that's why there's indecision playing across the market. And you can see that at the index level. We don't invest in FY23 now. We're investing for FY24. So that's what really counts. So that's what we're going to get onto in today's presentation. S&P 500 over in the US. Shawn, what's your take on this broad landscape? Because it's a little bit different in terms of the composition of the index, and the stocks and sectors that have been performing well this year are a higher weighting in this index than the likes of banks and resources in our own index.
No, very much so. Just very quickly, going back to the reporting season, I would also like to point out that there's a lot of uncertainty going forward. whether it be China, whether it be Russia, whether it be interest rates, have they peaked? Can we control inflation? So I think it's a lot of the management, they're being quite prudent when it comes to FY24. They just want to be in a position where if they underpromise and overdeliver, they look good. But if they go out there and say what they really think, they think they're pretty well positioned, all the risks are down. So I just think people are being quite prudent, and I wouldn't be surprised if in a year's time things actually look a bit better than they are today.
I reckon that's a great point, Shawn, and that's I can hear it in the underlying tone of management. They're sort of having a they're saying it's held up better than we thought. The economic outcomes have been better than we thought, but why hang our hats on something really onerous in terms of guiding the market? And the market is management out there are really savvy, or some management teams out there are quite savvy in how they communicate with the market, and those ones, particularly in the large cap areas of the market, they're pretty good at what they do. So I haven't come out of this reporting season, whether it's being FY23 results or the guidance in FY24, that we're imminently headed to something really sinister, that these rapid rise in interest rates have created this air pocket in our economy, and therefore an air pocket in company earnings. So I don't come out of reporting season, or as we go through it, I don't come out thinking that way. You touched on interest rate, Shawn. Really critical point. So RBA's paused the last couple of months. Are we done in terms of interest rates in this cycle?
Okay, well, just very quickly go back to the previous chart, because I didn't mention it. We've been looking for US stocks, and in particular tech, to pull back for quite a while. Over the last 4 to 6 weeks, the likes of the FANG stocks, the Magnificent Seven, as they're often called now, they've pulled back about 12%. We've gone from being short-term bearish to now looking for a time to start accumulating or going a bit more overweight the tech sector. It's an area we've played quite well of late. Today we sent out an alert where we're increasing our exposure to 0 from SEEK, but I think that's moving up the beta curve in terms of tech, and it's also moving away from a stock that didn't deliver very well. Obviously, 0, its major report will come out in November. So I think they've pulled back. They don't necessarily, as you said, James, have a huge correlation to our market, because it's a very, very tech-dominated index, whereas we're far more dominated by the resources, and hence we're far more correlated to the European indexes, and then specifically the FTSE and the Canadian market. And that's a whole different story. But I think the US indices, they're in an uptrend. They look pretty good. They're having a pullback on plenty of uncertainty, but a quick glance at that chart tells you it's hardly a pullback to worry about, considering what they've done over the last year and a bit.
Yeah, and recent quarterly updates over in the US were decidedly positive. So by and large, moving on to interest rates, same question applies. Have we peaked in terms of interest rates? The chart on your screen there is the Australian 3-year bond yield. We write a lot about bond yields, as subscribers will know, but they're really, really influential. We can't stress it enough. So 3-year bonds trading about 3.9%. Shawn, is that the highest they'll go in this cycle?
Well, I think so. I mean, I put that red arrow on there, so that's me putting it out there to be shot down, of course, over time. But it's so important to the price of equities. If you can put your money in the bank and get 4% on a 3-year bond, for example, then equities have got to outperform that by a few percent at the very least to make it worthwhile, because that's your risk-free rate of return. So that's what people look at. That's what fund managers look at. They look at the risk in equities, the risk in certain sectors. Is it enough to offset what I could get in the bank? And so the higher bond yields go, the more pressure on stocks that are dependent on borrowing, depending on growth, etc. As we saw when we had the big pullback in primarily the tech space in particular through 2022. So coming back to specifically what we look at here, we think central banks have done enough with the inflation. I think that we're going to see food prices in particular come back quite a lot over the next 2 quarters. And my only concern to this view is, of course, when it comes to energy prices. We've seen a sharp move up in energy over the last week or 2. But again, when we look at how our view is there, we think they've pretty much got to where we were saying. So in a nutshell, yes, I think bond yields, the 3-year bond yield will hit 3% before it hits 4.5%. There you go.
All right, interest rates have peaked. I mean, to give you an idea of where we're not we're not out on an island here in terms of rates. The market, so interest rate futures are pricing a cash rate to peak at 4.25%. So we're at 4.1 now, so 15 basis points of hikes. But that does price in a variety of views. So those who are in the camp of further interest rate hikes versus those who are in the camp of pricing an interest rate cut. So markets are suggesting that we're there in terms of interest rates. Ultimately, a peak in interest rates and the prospect of interest rate cuts are going to be influential in terms of equities. I want to move on to copper. We use copper for a number of reasons. We like looking at it from a broader economic sense to get a read there. What's your take? I'll stay on you, Shawn, because you are the macro the macro person in our business. So what are you seeing in terms of copper?
Okay, I think this is a story of two halves, James. We're very, very bullish. I'm very bullish. As a team, we're very bullish on copper over the medium to longer term. It's a huge position going forward in terms of what EVs, green energy needs. A lot of copper. It needs more copper than there is. The supply demand is fantastic for copper going forward in terms of being bullish, that is. However, short term, without doubt, China is the biggest user of copper, and until their housing market stabilizes, until they start rebuilding, copper is under a bit of pressure. As we can see there, it's down a fair bit. My view is copper could hit 350. That's 50-50 toss a coin. But the most important thing is copper, in our opinion, is going up medium to longer term. And any uncertainty in the short term that's coming out of China, to me, is producing a buying opportunity.
It's a view, Harry, that sort of is shared by BHP in the way they're repositioning in their business and how they see copper moving forward, isn't it?
Yeah, so obviously, future-facing commodities, you want to have exposure to copper in that respect. If you have a look at, it's often called Dr. Copper, so it's a bit of a bellwether in terms of global growth story and that sort of thing. But at the moment, we're starting to see inventory levels at plumbing pretty long-term lows now. So there is going to have to be some demand support kicking in. It probably comes on the back of Shawn's comments on how the China property outlook comes through. But overall, bullish copper, and BHP is now, building a reasonable position in copper and sort of alleviating their exposure to iron ore on the back of that as well. So, transitioning more away from that iron ore and continuing to diversify their exposure.
Yeah, BHP in FY25 is expected to have about 40% of its earnings coming from copper. Obviously, they bought Oz Minerals, which was nice for us. We own that stock, but it's a really indicative. We like using BHP because it's such a broad exposure in the commodities space, and it's really useful for forming our views on the broader commodity complex, Shawn.
No, totally. And it makes me think back to what Warren Buffett says when he says what stock or what, when he takes a position, he wants to think about owning it for 10 years, not 10 days. And if there's one of the stocks out there, one of the plays out there that I'd be happy to own for the next 5 or 10 years, it would be quality copper exposure. And BHP is arguably top of the list locally for that.
Yep. I'll just put out there, we don't think we're Warren Buffett. Shawn doesn't think he's Warren Buffett.
Definitely not. I'm too young for that.
I probably drink the same amount of Coke as Warren Buffett, but other than that, there's not a lot of similarities. But we do have our own. I think the one takeaway that we have from Warren Buffett is treading your own path, really, and approaching the markets from your own specific way. And I think that's what we try and get across at Market Matters in terms of the approach we take on the market, is both a top-down, bottom-up style approach, or more bottom-up looking at companies, along with Harry, and Shawn's more top-down looking up from a macro perspective. I think in the last couple of years that's worked incredibly well. I think the macro environment is going to continue to be really influential in terms of markets, and I think that approach is yielding results. And we've seen it in the past couple of years across our portfolios. I'm putting a chart of IGO up there, Harry. They've transitioned from they had gold exposure. They're now very much in the future-facing commodities space that you touched on there. We've had a couple of trades in IGO in recent times. We did we sold our position, some of our position, about $16, and we sold the balance of it about 14. What's your take on IGO? We like the company, but it's been incredibly weak in recent times.
Yeah. So obviously they're building their nickel exposure, moved away from that gold exposure. It's all about these future-facing commodities, and sometimes the market gets a little bit ahead of itself. You know, they paid up for a few assets that they probably spent a few too many dollars on to get that exposure. But overall, at some point, this story will play out, and I think they're well positioned to take advantage of that. They're probably just a little bit earlier, and I think we might have been a little bit early on it too. But overall, you know, like BHP, if you're looking at 2, 3, 5 years on this story, IGO in a pretty good spot, and they've got some reasonable assets to get them there.
We actually made great money on IGO, Shawn. We sold one parcel really well. We sold one less well, but it's looking good now. Where would you get keen on IGO again from a price perspective?
I wouldn't get too excited. I can see the stock making new lows for the year, unfortunately, James. You know, it's come out recently with not the greatest of news. We've seen it drop significantly, 25%, give or take. It's down another few percent today. So when it's in the naughty corner, as some people like to put it, it tends to stay there longer than people think. It goes a bit further than people think. And that's been a characteristic of the last year or two with stocks, is they tend to go up or down further than common sense would dictate. And I think that could be the case for the IGO. As Harry said, the thematic, the assets they've got are solid going forward. But if people are long, and it's a bit of a crowded space, I feel, I can see the stock falling a bit further than people anticipate.
Yeah, the news we're referring to is that they bought Western Areas, and then they've written down the bulk of the value that they bought Western Areas for. So Western Areas is nickel, and Harry mentioned at the outset around the reporting season trends about costs in the miners. So this is one of the things I'd really want to stress around mining companies that are doing development. It's really costly, and cost overruns are really difficult. Labor has been hard. Inflation has been obviously problematic in that space, and we've seen this big trend of cost overruns. What that does when projects are harder and more costly to do, it means that there's less incentive to go and build stuff, and there's more incentive to go and buy stuff that's already built. So I think that's one of the sort of concepts that we're grappling with in the mining space, is where the bigger guys like BHP, they launched a bid for Oz Minerals, and that's why they did it. They've got a de-risked asset that aligns with their own, and they're not taking this huge risk of development. And that's to me is a really key thing when you're thinking about commodities at this point in time. One commodity stock that we've spoken about over the last couple of years, we've done really well out of it. About 18 months ago, we've got a position in it now. We think it goes higher from here. Whitehaven Coal, the thesis around that, Shawn.
Well, I think this is probably a good example the second time around, to use Harry's phrase. We probably went a bit early buying it the second time around, but I'm very, very comfortable with Whitehaven Coal. I think the market overall, it's going to take longer for the ESG players to come through. It's going to take longer for us to be living in a green world, and we're going to need more coal. We're going to need more fossil fuels to get us there, to bridge the gap. And Whitehaven Coal is incredibly cheap at the moment. It's yielding phenomenally. And sure, by definition, it will be dictated by the coal price, but it's very, very cheap here. It's building in coal prices much, much lower than where they are today. And I can see that stock trading back at $10 in the next year or two.
It's interesting, coal prices in the last month, Harry, are up about 16%. So they are grinding higher from here. I guess that the main reason why you go out and buy something like a Whitehaven Coal, which is on the nose for a lot of investors, and we get it. We're not here to sort of preach from an environmental standpoint. Our belief is that this energy transition is going to take longer and cost more than anyone thinks. There's no new coal developments coming on stream for a whole bunch of reasons around financing, environmental approvals, and the like. So no new supply meets higher demand, and that should drive prices higher. You've spent a fair amount of time looking at the coal space. Harry, have you got anything to add in that respect?
Yeah, well, once again, it's the China story is starting to pull back a little bit. That will once again turn at some point. But we've also seen Indonesia sort of hit, all-time highs in terms of coal demand there, and India, and there's a lot of economies out there that still heavily rely on this. They don't have the capital to go out and build big, solar panels or wind farms or ESG sort of friendly electricity hubs. Whereas coal, it's an easier sort of access to electricity. So there is still that demand tailwind. Like you said, it's going to take a lot of fossil fuels to get us to a point where we can sort of lower our emissions. But for now, coal looks quite supportive. If we can't bring on new assets and new supply, that will continue to trend higher, and that seems to be the case again with Whitehaven. So it looks like it's turned a corner in terms of the coal price at the moment, even in the last couple of weeks.
Yeah, restocking should drive the coal price higher.
Probably a slight risk we should all throw in there is governments, and the governments are short of money at the moment. We all know that after COVID, and there's always the risk of more taxation coming through over time. It's an area where they get plenty of popularity by taxing more, and that might play out a bit further down the track. But if that doesn't come through, they look incredibly cheap.
Yeah, so we're targeting sort of a retest of those recent highs. It did obviously get to $11. We don't expect it to get that high, but it's going to throw off a lot of cash flow along the way. So we like Whitehaven Coal there. Worley Parsons is the complete other end of the spectrum. So when you think about the energy transition, I think there's two taking a step back. I think there's two major trends globally that we really we're focusing a lot of our research efforts and thinking about is the energy transition as well as AI, etc. We're probably a little bit further down the path of the energy transition around our understanding of that than AI, but that is going to be a huge change from a productivity standpoint globally. Taking a step back to the energy transition for a moment, Worley Parsons is going to be instrumental in this energy transition. So they're a consulting business, contracting business. They have about 50,000 employees globally. They've traditionally been earning the bulk of their earnings from lower margin maintenance sort of businesses or work. Now they're going about 40% of their book is around involved in the energy transition. There's going to be about a fourfold increase in energy investment over the coming decades. And this, in my view, is going to drive Worley Parsons higher. It's going to twofold. The market's growing. Their share of that market's growing, and the margins they're earning on the work they're doing is expanding. And I think that's obviously driven the share price higher, Shawn. But we still like Worley Parsons.
Absolutely, I'm very, very comfortable. Famous last words, hopefully not, with Worley Parsons. And I think this is a really important point to make, is we like stocks like Worley Parsons and BHP, believe it or not, with the copper side of things, as a way to play the energy transition, as opposed to where a lot of people are going into the lithium space. Some of these lithium stocks, as we know, are going to have huge moves and huge volatility and massive gains for the right stock. But there's a lot of uncertainty in there because this is more of a chemical process as opposed to traditional mining. And one needs to be very, very comfortable with the stock you're buying and at what levels. And that's why the volatility is so large. So from a long-term perspective, I prefer stocks like Worley Parsons and BHP or Sandfire to play the transition at this point in time.
Yeah, just Harry, have you got anything to add on Worley? It's the larger cap. You're more focused on the mid cap space, but it's definitely a trend. You've got other exposures in your portfolios that have got are exposed to similar themes.
Yeah, similar things. Worley specific though, there's massive amount of work out there for them to bid on and get access to over the next few years. And it's not going to take a massive uplift in margins to see those earnings really turn the dial in there. So, really well-positioned company, and they are starting to pull those levers in terms of building those margins and growing those margins, and in turn, growing earnings pretty significantly over the medium term. I'll call out, Calix is one that we've sort of got access to. It's a similar sort of space. It's obviously, pretty new technology coming out at the moment. They've got to deal with Pilbara. They've got about 70 deals in the pipeline at the moment. And that's the whole idea, is about, changing some industrial sort of processes to really reduce emissions on the back of that. And Worley's sort of in a similar space. I think the demand for these companies and what they bring to the table, is obviously building and growing, and they'll play major parts in the next few years.
CXL is the code for that if anyone was interested in Calix. Just finishing on Worley, I think they've never had an issue winning work. They've had an issue delivering work in a profitable way. And I think this is, they had a strategy day recently, and they articulated a really plausible path to an increased margins, obviously helped by the big spend that's going into this space. But that's a stock. I know it's run hard into results. Reports shortly. I think it reports on the 23rd from memory of August. So there's probably some risk around that result, given there's a lot of optimism now built into it. I've read a lot about from other fund managers who are now sort of jumped on the Worley bandwagon. So I guess from a positioning point of view, I don't think I'd jump out and buy it pre-results. If you don't already, if we didn't already own it, we probably wouldn't be jumping out there buying it pre-results, but we like it in the medium term. Let's move on into Iluka. This is one we've got really right in the last, since we sold it. It's been hit really hard. Just in terms of, so we used to earn, this is a mineral sands business that is also going into the rare earth space. We actually liked this stock from a longer term perspective, but the last time we sold it around $11.66 about 2 months ago, and it had huge outperformance. It's obviously China related, and they're making a big push in the rare earths, so they're developing a mine. So this is very, very typical of how we approach the resource space, Shawn, and being active around how we're doing so.
No, exactly. I'll just clarify what I said before, if you don't mind, about lithium stocks. It's not that we don't like lithium stock. It's just that they're volatile. There are inherent risks there. So you don't have to chase them into strength. If you look at something like Pilbara, 30 or 40% pullbacks are very common. So chasing them into strength is a lot of risk there. And the same thing with Iluka. You've got a mineral sands business, but they're also talking up, or have been, the potential from their rare earths business. But again, that is new business coming on board. How much is it going to cost? How efficiently will they bring us on board? How quick, how much will it cost them to get the actual earnings onto the bottom line, as Harry was saying? So I think with Iluka, I like the stock. I don't have a problem with the stock at all, but I wouldn't be surprised to see us being able to buy that near $8.50, for example, $8. And that's a 50% drop from where we got out almost.
Yeah, I'll put this chart in just to show you how we need to be. We promote this active approach to investment management. It's not about trading, but it's about trying to pick the eyes out of the companies we own. We're not here to own companies for the next 20 years. We're here to try and generate earnings, returns out of the positions we have in a medium term, with a medium term view. That's what we're all about. And I think the chart of Iluka was a really instrumental one. 2 months ago it was near $12. There were signs that there were risks there that the market wasn't appreciating. So we took our profits and moved on, Harry.
Yeah, if you come back to the mineral sands market, in particular, we've owned, Strandline in the emerging companies portfolio as well. That it's a really, leveraged market in terms of, building starts out there globally, and that market's been under a lot of pressure as well. So there was cracks in their main business, in that mineral sands business, while they're trying to build this massive rare earths business within that. So obviously they're going to have to fund that rare earths build from somewhere. There's cracks coming through on their earnings as well. That is pretty much a cause for concern. Once again, that mineral sands market will turn at some point. We will keep an eye across Iluka. We're keeping an eye across Strandline as that plumbs, long-term lows as well. So these are stocks that we aren't just throwing them out and forgetting, but we'll come back to them and keep revisiting them, weekly or monthly, just to take a look at where that's going and what the market's sort of telling us with the price.
Yeah, sorry, James. That's a really, really good point. I'm probably about to say what you were, James. But it comes back to risk reward. We often write about that in our reports, Harry. The stock had rallied 50% from 2022. It was building in a lot of good news from both the mineral sands and the rare earths, and we just felt that it wasn't taking into account the potential risks enough. So it wasn't a case that Market Matters didn't like Iluka. We just didn't think it warranted chasing the stock around $12.
100%.
Doesn't mean we went back in.
100%. So when we sell something, it's not a sign that we dislike the company or there's something imminent bad about to happen. I think the risk reward doesn't stack up. The same was true. You made mention of Strandline, so that's STA. I did a webinar with a couple of other analysts, probably 12 or so months ago. We ultimately sold Strandline just sub 40 cents, I think, Harry, or high 30s. The stock's gone down a long way since. We sold it because they were coming into production. And those things create complexity, and things go wrong when mining companies are coming into production or building, building new mines or about to produce from new mines. So to us, the risk goes up. So we've got to factor that into our decision making. So if we've got great profits in there, why take the added risk around that? So that's probably a key thing to think about when we're selling stocks, why we're actually doing it. One stock that risk reward probably is not as compelling as when we bought it. So AGL, we bought sub $7. We've actually had a couple of good trades in it. It's been the best performing stock in our income portfolio over the last couple of years. Aggregate return is well over 200%. We still own it, but we trimmed it down to a targeted 3% weighting before they reported. We like this stock. I'm not going to focus too much on it, but the reason I put this in there is to show the gains you can have from large cap stocks if you pick an inflection point where a company is changing, as a company moves from being one way to another, and that can happen on both sides. So this has been a huge change for AGL in the way they approach decarbonisation and what they're doing with their assets, driven by activist investors, Mike Cannon-Brookes, who's Joe Aston calls the double bay Jesus, but it's indicative of what we try and do. We're trying to pick inflection points. We're trying to get out when risk reward dictates we should, and trying to get in when risk reward looks good, with the knowledge that we can change our mind and cut our positions if we believe we're wrong at the time.
And I think there's another thing to add there as well, James. That's the position that you've trimmed, and that's something we often do at Market Matters. It's a case of we want to stay with AGL. We think it's gone a bit too far. We're not traders. We're investors. We're active investors. So there is an appropriate time. Sure, Luca, we sold the whole thing, but other times we've trimmed stocks such as AGL, such as Sandfire. So there's a couple of ways to skin the cat, so to speak.
Indeed. I'll bring Harry in here. Bapcor, they reported yesterday. So we're moving from, so we've had a look at resources, a couple of our more different energy plays in Worley and AGL. Now we're on to retailing. We've done a little section on retailing today because it's been probably one of the more resilient areas of the market that the market hasn't is priced in more risk than they should have. Bapcor, you've got in a portfolio, Harry. Yesterday's result good, and what's the outlook here?
Yeah, it was a really good result. It wasn't actually a standout result if you put it up against where consensus numbers were. It was pretty much in line. We've had a number of discussions on the desk about Bapcor, James, and whether that's better to be in or ARB, or there's a couple of other names in the space. And ultimately we stuck with Bapcor because we just didn't think the market was giving them a fair price for what their outlook was. They've been really good in terms of talking about where they're going to be in FY23, where they're going to be in FY24, and they've started to give really good feedback to the market about where they're going to be in FY25, and that's ultimately why the stock rallied yesterday. Is they're going to target about $100 million in the EBIT improvement by FY25. The market had only given them about $60 million, and this is all on the back of a project they put in place 12 months ago called Better Than Before. So it sort of flagged to me that probably the share price should be a bit higher if you're putting in a project called Better Than Before. They're starting to hit targets in that respect. The markets started yesterday to give them some value in that respect as well. So I think it's a little bit cheap in terms of where it trades historically. It doesn't have a huge retail exposure. It's only about 20% of retail exposure within earnings there. But overall, I think it was a solid enough result. But the market just didn't quite grasp how that company is going to be tracking in 12 to 24 months' time, James.
Yeah, you were writing on Bloomberg yesterday, Shawn, how good it looks technically. You were getting excited about Bapcor after they reported results.
I was. Well, actually said that before that the market digested the results, and I can still see the stock trading at $758. It looks great, and it's a good example, as Harry said. The results weren't knocking it out of the park, but it was just the market was underestimating what it could do, and I think it looks fantastic, and I think it's a stock it's down a bit today, as is most of the market. I think it looks great. Anyone that wants any retail exposure, might not be 100% retail, as Harry said. I think it's a really good addition to a portfolio.
There's the confidence they showed. They put a Sort of it's not an aspirational target, but it was a target for FY25 in terms of the EBIT improvement they were going to do. They've put a big number out there. The market didn't believe that. Then they've shown that they are incrementally getting to that number, and they've guided to FY24 that should at least get them to that number in FY25. So they're a little bit different. They've put out a confident statement and delivered on it. Super Retail, Harry, you were looking at this one before. This is a good result today, and you know, you look at this chart and you go, are we headed for an imminent recession? These guys obviously have a broad suite of retail brands, from Rebel, who's benefited from all the selling of Matilda's attire over the past couple of weeks, to BCF, to Super Retail Group, to Super Retail, I should say, Super Cheap Auto, I should say, got there eventually. Yeah, these guys are just delivering, right? They've done phenomenally well.
Yeah, consistent delivery from Super Retail was probably the main point, and their margins held up reasonably well. It was an inline revenue print. It was a small beat on profit, and that's probably, you know, tick a box for retail at the moment. If you can do enough to hold your revenue firm and do a little bit in terms of costs and your inventory levels and that sort of thing, you're going to do reasonably well in terms of results. And we've seen that today on the stock. It popped over $14. Briefly, it's back a little bit below that last I checked. But if you have a look at, you know, their outlook statement, July was okay. Their total sales are up 2% to start off FY24 as well. So once again, holding firm. It was actually surprising. You've been to Rebel a couple of times over the last few weeks, James, to pick up some
I love a bandwagon. I love a bandwagon.
But, Rebel was actually, you know, pretty much flat there too. So it's been, you know, a really diversified business that continues to, you know, hold their revenue pretty well, even if there is some, you know, cracks within retail, and they've done pretty well in terms of their cost to hold those margins up.
Yeah, I think we're just saying that well, what we're seeing, I think, James, is the cream floating to the top within that sector.
Yeah.
You know, if you were sitting there owning someone like Harvey Norman, you've had a pretty tough year or two.
Totally. And I think this is it speaks to how we approach the, you know, markets. We're pretty open-minded in how we approach the market. And you can see that some companies within sectors that should theoretically be struggling actually do pretty well. So you have macro views around how we position portfolios, and we have sector views stemming from the back of that, but it still doesn't proclaim us from looking at stocks within sectors. Maybe there's the, you know, macro headwinds that are facing a sector, but there still will be winners within that sector if they're well-managed companies. Premier Investments is one that hasn't run as hard, Harry. We do own this in our emerging companies portfolio, and we like it here. It's a little bit muted in terms of share price performance in the last little while. But you know, what's our take here right now? Should we be buying more of Premier?
Yeah, if we turn back to when we bought Premier, we switched out of Lovisa at the time. Lovisa had run really hard. Premier hadn't run all that well. Yeah, and Lovisa's pulled back a little bit, and Premier's sort of held its own since we picked that one up. It's a really good business, run really well, really diversified in terms of they've got investments in Myer, they've got investments in Breville, and they've got their own brands, suite of brands there too. They're really well capitalized. If you take out those investments they've got in the cash on the balance sheet, it's trading incredibly cheap on a PE multiple there too. So overall, I don't think that the you know, headwinds that are facing retail will as much affect Premier, and that's why we continue to hold the stock. We are sort of, you know, seeing retail turn the dial a little bit. Everyone's been really bearish. You saw that chart with Super Retail, how that can turn and how that can be reflected in stocks specifically. I think there's still a lot of bearishness out there for Premier, and that's what's holding that back. But if that starts to turn, it can get a pretty decent run on. These guys are a July year end, so we won't hear them report until next month, and I think that will be one we'll be watching very closely, as we do with all the stocks we hold in portfolios, James.
All right, I'm going to move on. I won't tie you into that one, Shawn, but the area that's been poor that you framed, Harry, in terms of results was property. Dexus came out, and we own this in our income portfolio. We bought it around $8. We've got a distribution out of it. We're slightly ahead on the position, but it's a difficult stock to own because the news flow is so bearish. Is everyone too bearish on property, Shawn?
I think they are, James. We've been writing about that slowly but surely over the last few weeks. it could go a bit further. There's no two ways about it, and I think you have to choose where you go. We recently, in the flagship growth portfolio, switched from Goodman Group to National Storage.
That doesn't look good today, does it?
No, it doesn't look great today. I felt pretty good on when I saw the Goodman Group result. I thought they'd missed slightly, but the market's looking further afield into the future. But yeah, I think the sector is. I think it's one of those plays where if you start accumulating property now, you'll look very good in the next year or two. Exactly which ones? It's a bit trickier. We talked about CNI this morning. It's my feeling is that the sector will look good in a year or two's time, maybe not a week or two's time.
Yeah, to give you an idea of Dexus's result yesterday, so they had we all know that they were trading at about a 30% discount to their NTA, so the value of their underlying assets. They revised those. Their NTA went down about 11.4% based on the revaluations that came through yesterday. That means that it's still trading at about a 28% discount to the value of its assets. So when you're thinking about a stock like this is what the market is pricing it versus what external valuations are pricing their office buildings, etc. These guys are high quality, so the high end of the market, so they've been performing better than the lower tier assets. So I like Dexus. I think there's challenges around what they're over the next 12 months. There's uncertainty around what office will look like. It comes down to whether or not the share price is trading at enough discount, but factoring those risks in, and I think it is, and that's why we own Dexus, and we'd be happy buyers of Dexus here, Harry.
Yeah, like the office space, given it's trading such a big discount, we don't like the office space specifically. So it's factoring in that price differential between NTA and where the stock's trading. They went out and bought some assets off A&P lately as well, so they've got a bit of work to do there. They've got a few levers they can pull to sort of drive those earnings and support those earnings, and as a result, support dividends out there for shareholders too, James.
Yeah, I got off the call yesterday with Dexus, and they're obviously the challenges out there, but they're dealing with them. They've got manageable gearing sub 30%. They've got high occupancy. They're about 86% hedged, I think, in terms of their debt exposures. Like, they're really good operators. They'll get through, and they won't be trading at $8 in a couple of years. Goodman Group, we touched on it just now, Shawn. So FY23 result was solid. Their guidance for FY24 growth of about 9% at the EPS line was about 2% below market. But Greg Goodman, I've spoken to a lot of, I've spoken to people who work at Goodman who know Goodman very well. Greg Goodman is just the messiah of property, and he's done it again. He's articulated them, I guess, movement towards data centers, etc. We sold this on valuation grounds. We thought the earnings stemming from development would taper off over the coming 12 months. And because the market was so bullish on their earnings outlook for Goodman, that they were susceptible to downgrades. Their guidance implies slight weakness versus consensus, but these guys have delivered again, Shawn. We've probably got this one wrong, would be my view.
Well, it certainly feels like it today, James, but this is a volatile market, so time will tell. But this is a good time to point out to subscribers that our goal at Market Matters is to outperform the index month in, month out, year in, year out. And so if we have to push the button and say we're wrong and buy Goodman back at a higher price than what we exited at, we will. We won't, we're not out there saying we want to buy Goodman's at $17 and we won't press the button and pay a higher price. We will buy the new story. It's changed. The picture might have changed. We'll reevaluate that over the coming days and weeks and months, and we might re-enter a higher price.
Absolutely. One of the things we did, we switched out of Goodman and bought National Storage. So we got National Storage around 220. NSR. So these guys are the largest self-storage operator in Australia. They've been sold down, as you can see, pretty hard recently on the back of Abacus, which is Abacus Property Group, spun out the Storage King assets that they held. That's now listed under ASK, Abacus Storage King. Raising new money, they did it at quite a steep discount to their NTA. National Storage traditionally trades at a premium to their NTA because of that relative valuation with Abacus. It put downward pressure on NSR. So that's why that stock has been pulled back. but we like this longer term. So we're using the weakness and the catalyst that saw the stock price lower to accumulate a really high quality storage business, yielding 5%, growing at 5 to 10% over the next few years. And they've also got levers to pull. Harry, I mentioned Goodman around pivoting into data centers, or increasing the use of data centers. Storage assets are big sheds, right? They've got a lot of roof space, and this energy transition that's going to require a lot of solar, etc. Storage assets are really looking at how they can utilize the roof space of their storage facilities.
Yeah, they're already pretty low, energy users, but it's how they can sort of plug back into the energy complex and use some of that space. Obviously, like you said, massive footprint in terms of land, massive opportunity in terms of how they can leverage that. The storage itself has got a bit of a tailwind over recent months and years as well. I know for a fact, I know some people that picked up their first storage space in the last month. So there is this tailwind of people having to move out of houses into apartments. They're getting some tailwind in terms of demand there too, and they've got the dynamic pricing model that they can sort of charge a market rate on the day as well to get that deal over the line. So once again, number of levers there, whether it's energy, whether it's pricing, whether it's this macro trend of picking up storage assets and picking up storage space across the board. I think they're doing quite well, and it's a really quality business, like you said.
Yeah, I agree. They've had a couple of takeover tilts in recent years. So 240 was the last bid that came through for national storage out of Europe. PEXA, Harry, PXA, it's a recent acquisition for the emerging companies portfolio. Really brief update here. You still like PXA?
Yeah, definitely still like PEXA. It's trading a little bit behind where we bought it, not a long way behind. They'll come out with their full year 23 numbers in the next week or so. It's one that we've done a lot of work on, talking about mortgage cliff and mortgage refinance, and volumes in property picking up. So these guys, they're play in that space. They pick up a little clip on some home sales and some remortgages out there. All the data we're looking at is that their second half should be a little bit better than their first half. The market's not pricing that in at all. So we think that this one should report quite well. It's a stock we really like. It's a stock that's got some regulatory tailwinds as well. So it's not just a short term. We're looking at it for this result. We're looking at it over the next 6, 12, 18 months as well. So I think this one's a pretty good position, a really solid company with a really solid product that could do quite well over the medium term.
Yeah, PEXA, I like this one. We've spoken a bit about this one in reports. Yeti's one in our international equities portfolio. So just to bring in some international stocks that we write about, the international portfolio has been actually the best performing portfolio last year, and it's been a really strong performing portfolio over the last couple of years, I should say. We're working hard to bring the international equities portfolio onto the Market Matters Invest platform to allow subscribers and others to invest easily in these direct international equities via a managed portfolio. So from our understanding, it's going to be released this side of Christmas. So keep an eye out for that. Yeti is, I ran into these guys at the boat show in Sydney or 2 weeks ago. They had a big stand there. They're coolers, eskies, if you like, but high-end stuff. So they put them on. They do deals with boating companies and leisure companies and all of that to supply these high-end coolers to those products. Great company. It's been on its knees, as you can see, coming back from 108 down to $27 a share. But they reported really well. They were up 17% last week. One I really like in the international equity space, Shawn.
Absolutely, and you're more into the boats than myself, James. But I think this stock, again, it's got $60 all over it. It looks fantastic. The momentum's turning, and any stock at the moment that comes out with some reasonably good numbers and is priced the other way around is delivering over the following months. That's an important thing to bear in mind. Good reports are tending to follow through. Bad reports are not. One of the reasons why we exited Seek today.
Exactly right. I'll miss you on that one, Harry. First Solar, FSLR is another one that we've added to our international equities portfolio. These guys make solar panels for industrial applications over in the US. These guys have got phenomenal growth. It's a big company. It's a $20 billion company. But we've spoken a bit about the energy transition, and we've spoken a lot about this company on the desk. It's a really good one. I know it doesn't look great on the charts, but this is a company that I really like.
Yeah, absolutely. And I think from the charting point of view, you're right. It's one of those stocks I'd just leave some ammunition. If it does dip down towards that 170, 180, top it up. Don't get out. So if you've got that as part of your original plan when you enter the stock, I think it's great. A pullback's a good thing.
Which we do. Now, I'm just we're coming out of time. BHP we've spoken about. I just want I was in a meeting this morning, a macroeconomic meeting with our CIO, Martin Crabb, and he put a couple of interesting charts up that I thought I'd rehash to you now. This looks at returns out of the S&P 500 since 1955, depending on whether or not global growth is improving or global growth is detracting. So when you look at returns, when growth is, when you look at normal returns per annum, you get about 10% out of the S&P 500. Sorry, you get about 7% out of the S&P 500. But when you buy the S&P 500, when growth is trending up, you get about 10%, and when growth is trending down, you get negative 2.5%. So if global growth is starting to tick up, you should be buying equities. And you know what? Global growth is determined by the OECD composite leading indicators are starting to turn up. So this is just a quick timing thing. So it makes real sense. When growth is turning up, you buy equities. And in the last couple of years, growth has struggled. So you can clearly see on the chart there, we've had declining growth in the last couple of years, and we're now seeing signs that growth in terms of OECD composite leading indices are ticking higher. So a reasonable backdrop for equities. I'll finish. I've got a couple of questions here, guys, before I get on to just promoting the Market Matters Invest service. So IGO from Chris, it's pulled back. Did we give a price target in terms of IGO on the downside? Shawn, you've got the charts in front of you, no doubt.
I'm just pulling it up now, James. I was on a different chart, so I do apologize. But yeah, I think I did at the time. My comment was, and I'm going to stick with it. I think I can see it well under, back around that $11.50, $11 mark. I think the comment I said at the time, I can see new lows for 2023. The market didn't like what the news about Western areas. It's in the naughty corner. It's likely to go lower for longer. So it's not short-term a buy, in my opinion, but it will get some good valuation, probably sooner rather than later.
Yep. Gregory's asking just about view on Transurban TCL with increased profit and impending takeover. Not sure about takeover. I'm not a huge fan of TCL here. I think they've obviously had they've earned a lot in the past 12 months. The dividend guidance for the next 12 months seemed a little bit light on them. They've got some things that will benefit, capital releases that will benefit the dividend, and they baked that into the cake yesterday. So I thought the dividend guidance was a little bit light on. So I'm a little bit so-so on Transurban. We're not rushing to buy it in our income portfolio. Ron's asking thoughts on super retail. Would we be buying it here, Harry? I don't know what your thoughts are there. I'll flow that one to you.
Yeah, a good result. I think there's still a lot of bearishness. I know we talked to a number of people on the desk about super retail, what they see about it, and it sort of has defied odds over the last few weeks about how strong it's rallied. It's probably at a point around that $14 level. It's probably at a point where fundies are going to have to make a call on it, and I think that call is probably to lighten super retail around here. But overall, it's a good result and probably deserves to be where it's trading at the moment. Probably not chasing it here and now at the moment, James. I know we've talked about it recently. It's probably a pullback, one to look at into a pullback.
Yeah, I think Shawn made the point earlier. It's a good one. It's not the market we need to be chasing things. So if we miss super retail and it keeps going, there'll be other opportunities out there. We won't be forced to chase stocks in this market. Each portfolio of Market Matters has got about 20 positions, so we can be selective in what we own. In terms of gold, is gold bottoming, Shawn? Chris is asking. Obviously, US dollar strength in the last little while has been a big negative influence on gold, but it ticked below in terms of spot sub 1900 overnight.
No, absolutely. Well, I have made a comment a few times in the macro report. I can see the US dollar getting back to 105. If that happens, it's not doing anything really at the end of the day. It's just having a begrudging bounce. I believe that gold is very much in that accumulation area. If it dips its nose under 1900, even around here, I see evolution's lower today. I think that we want to maintain our gold exposure. It's in that area where I would say it's looking for a low. Couldn't it go lower? Yes, of course it can, especially if the US dollar pushes higher. But I believe it's time to be accumulating gold. So we don't intend to reduce our exposure.
All right, Nick's just asking, what about is Min comparable to IGO? Nick, there's some overlap. So both have got lithium exposure, but Min's got three main divisions to its business. So they've got mining services, they've got an iron ore business, and then they've got a lithium business. So a little bit different to IGO. IGO's nickel mining about 25% of their business, and about the balances in the lithium space. So Min's taking the earnings they're generating out of iron ore and mining services and using it to fund lithium. So that's why we like Min better than we do like IGO at this point in time. Any views on Bubba since the recent restructuring? Alex has asked. Yeah, we like Bubba here. One of the a mate who runs who manages money for a large wealthy individual sent me a note on Bubba the other day that they've done a heap of DD on Bubba and unlocking the value of the parts, etc. And it looks really interesting. So yeah, Bubba I think looks deep value down here. We're at 1 o'clock, so I'm going to wrap up now. But I just wanted to thank the team, Harry, portfolio manager, Shawn, research lead at Market Matters.
Thank you.
Thanks, James.
It's really a team effort here, and I think I wanted to get that across around how each individual on our team has different levels of expertise. And one of the areas that have really helped us over the last couple of years is around our key insights into the macro environment, and having someone like Shawn dedicated to looking at the macroeconomic environment and providing ideas around that. I touched on at the start, we've launched recently a platform that allows direct investment into the Market Matters portfolios. It's called Market Matters Invest. We're encouraging people to have a look at it. We think it's a great platform. It combines the three things we're really passionate about in terms of transparency, timeliness, and so far performance. So we hope the strong track record of performance continues at Market Matters. We'll work hard to make sure that each and every day we're getting up and looking at the opportunities we've got in the market and working hard to sort of unlock the value in those opportunities. So thanks for so many of you joining today's webinar. Really appreciate it. We'll have more of these to come. So we're trying to roll out one of these about once a month. So keep an eye out for these in the future. Thanks again for joining us. Bye for now.